Investing for beginners. 5 simple steps to build wealth. Did you know that if you invested just $10 a day starting at age 20, you could have over $1 million by retirement? But here's the thing. Most people never start because they think investing is complicated or risky. The truth? It's easier than you think. Stick around because in this video, you'll learn 5 simple, proven steps to start investing today and build wealth for your future. Step 1. Master the basics. What is investing? Let's start with the big question. What exactly is investing? At its core, investing is putting your money to work so it grows over time. Think of it like planting a tree. In the beginning, it's just a small seed. But with time, sunlight, and care, it grows into something huge that provides shade, and in this case, financial security. The biggest advantage of investing is compound interest. Albert Einstein called it the 8th wonder of the world. Why? Because your money earns interest, and then that interest earns interest, creating a snowball effect. For example, let's take Sarah and Mike. Sarah starts investing at 25, putting away just $200 a month into a simple index fund earning 8% per year. Mike waits until 35 to start and invests double, $400 per month. By 65, Sarah has over $500,000 more than Mike, even though he invested more. The key? Starting early. Step 2. Set clear investment goals. Before you start investing, ask yourself, what am I investing for? Is it for retirement? Buying a home? Achieving financial freedom? Setting clear goals helps you determine how much risk you can take and which investments suit you best. A short-term goal, like saving for a house in 5 years, might require low-risk investments like bonds or high-yield savings. A long-term goal, like retirement in 30 years, allows for higher-risk, higher-reward investments like stocks and index funds. Pro tip: write down your investment goal and a target number. Studies show that people who write down their goals are 42% more likely to achieve them. Step 3. Choose the right investment accounts. Now that you know your goal, where do you invest? If you're in the U.S., you have great options. 4. 401k or 403b. If your job offers this, start here. Many companies match your contributions, which is free money you shouldn't leave on the table. Roth IRA and traditional IRA. These help you invest tax-free or tax-deferred, meaning you keep more of your money. Brokerage accounts. If you've maxed out the above, a taxable account gives you even more investing freedom. A simple way to start? Use a robo-advisor like Wealthfront or M1 Finance, or open a Vanguard or Fidelity account. These platforms make investing easy and automated. Step 4. Invest in the right assets. The simple portfolio strategy. Here's the part that confuses most beginners. What do you actually invest in? The simplest strategy? Index funds and ETFs. These are like a basket of stocks that spread your money across hundreds or even thousands of companies, reducing risk while still growing your wealth. For example, if you invest in the S&P 500 index fund, like VOO or FXAX, you're automatically invested in 500 of America's biggest companies: Apple, Microsoft, Amazon, and more. Over the last 50 years, the S&P 500 has averaged around 8 to 10% returns per year. Let's break it down. If you invest $500 a month into an S&P 500 index fund for 30 years, assuming a 9% return, you'd end up with over $1 million. And you don't need to pick individual stocks, study the market, or spend hours on research. Just set it and forget it. For diversification, consider this simple 3-fund portfolio. 60% stocks, S&P 500 or total market index fund. 30% bonds for stability. 10% international stocks. Step 5. Automate and stay consistent. The biggest mistake people make? They invest once and forget about it. The best investors, whether Warren Buffett or everyday millionaires, invest consistently. And the easiest way to do that? Automation. Set up automatic contributions so money goes straight from your paycheck or bank account into your investments. Use the dollar-cost averaging strategy, which means investing a fixed amount regularly, whether the market is up or down. This smooths out risks over time. And here's the most important part: never panic sell. The stock market goes up and down, but historically, it always trends up. For example, in 2008, the market crashed by over 50%. But if you stayed invested, the S&P 500 more than tripled in the next decade. Those who stayed in the game built wealth. Those who panicked lost out. Final thoughts: how to start investing today. Now that you know the 5 steps, let's make it simple. 1. Decide on your investment goal: retirement, home, financial freedom. 2. Pick an investment account: 401k, IRA, or brokerage. 3. Start with index funds or ETFs, no need to pick stocks. 4. Automate your investing: set it and forget it. 5. Stay consistent and think long-term. Don't let short-term market swings scare you. Question for you: what's stopping you from investing right now? Drop a comment below. I'll personally reply to as many as I can. And if you found this helpful, hit that like button and subscribe because we have more wealth-building videos coming every week. See you in the next one. Happy investing!